Financial markets play a significant role in the growth of the economy by drawing investors and their savings, which are then invested in various assets. The information public about these assets reflect the market situation and help investors make informed decisions when choosing investments. In efficient markets, this information is readily available to all participants, allowing them to choose from best investment options available. Essentially, financial markets help ensure that money flows through where it can be used most effectively for economic growth. The cost of capital refers to the amount of money that a company must pay in order to obtain financing for its operations. This can include both debt, such as loans, bonds, and equity, which is ownership in the company through stocks or other investments. Essentially, it is the expense that a business incurs when raising funds from investor or lenders. For example, if a company needs 1 million to expand its operations and decides to issue new shares of stock to raise this capital, it will need to calculate the cost of the funding. This may involve taking into account factors such as dividends paid out on these shares over time and any potential dilution of existing shareholders, ownerships, and stakes. The cost of capital is important for businesses because it helps them evaluate different financing options and make informed decisions about how best to fund their growth plans. Determining the proportion of each source of capital that will be raised. So, financial managers aim to estimate the optimal capital structure for their company. Considering that the preferred stock and common stock, initially, they can calculate the proportion of each type of capital based on book values from the balance sheets. However, book values may not provide the desired information as market values are more relevant. Obtaining market values for publicly traded securities is straightforward, but for privately placed capital estimation methods can be used. By determining the market values of debt, preferred stock, and common stock, financial managers can assess the current capital mix. Then this analysis helps in understand the company's preferred capital structure for the future, while the present capital structure serves as an approximation. The focus is on the company's analysis and decision regarding future capital structure adjustments. Estimating the marginal cost of each source of capital. The cost of debt is amount of money it takes to borrow $1 more by issuing debt. So, if you borrow $1 and promise to pay it back in a year, plus additional $0.10 for using the lender's money, how much does the dollar really cost you? Well, it depends on your marginal tax rate, which is the tax rate on your next taxable income. This is because we want to see how taking out a loan affects your taxes by deducting the interest paid from your income. We can compare taxes with and without the interest deduction to determine its impact on your overall tax bill. The cost of preferred equity refers to the expense involved in raising additional funds by issuing shares of preferred stock. Preferred stock is a type of investment that does not have an expiration date, meaning it will never mature. Typically, preferred stocks offer fixed dividend rates which are expressed as a percentage of the par value of each share. To calculate the value of preferred equity, we need to determine its present value. This means taking into account various factors such as interest rates and inflation. In order to estimate how much money invested today will be worth in the future, by determining this present value, we can better understand the potential return on investment for purchasing shares of preferred stock. The cost of common equity refers to the cost of company incurs when it raises more capital from its shareholders. This can happen in two ways, either by retaining earnings or by issuing new shares of stock. When a company generates funds, some portion is used to pay off creditors and preferred shareholders, while the remaining amount is owned by common shareholders. The company may choose to retain these funds for investment purposes or distribute them as cash dividends among the shareholders. When company raises more capital from its common shareholders, either internally or externally, there are costs involved such as opportunity cost for retained earnings and additional expenses for issuing new shares externally. However, determining precise cost related to external issuance can be challenging due to unknown variables like future dividend streams and changes in share prices over time based on investor expectation about future performance beyond current dividend payments. Cost of common equity using the dividend valuation model. The dividend valuation model is a method used to determine the price of share of stock. It calculates this by considering all future cash dividends that the stock will pay out and then discounting them at a rate called the required rate of return on equity. Or if these dividends are expected to remain constant forever, like with preferred stocks, we can use something called a perpetuity to calculate the cost of common stock. However, in reality, common stock dividends usually do not stay constant. This means that calculating their value using DVM becomes more complicated because we need to take into account changes in future dividend payments over time. Cost of common equity using the capital asset pricing model. The investor's required rate of return is a combination of compensation for the time value of money and risk. The capital asset pricing model assumes investors hold diversified portfolios where the only risk left is market risk. Investors being risk adverse see compensation for taking on risk, with market risk being the relevant factor in valuing investments. The greater the market risk, the higher the compensation and yield, leading to a lower present value of the asset due to higher discount rates reflecting the risk. The cost of common equity calculated using the CEPM or capital asset pricing model includes compensation for the time value of money and market risk of the stock. Investors holding diversified portfolios only need compensation for market risk, which influences the investment's price. The risk associated with movements in the market as a whole determines the investments, with higher market risk resulting in higher compensation and yield, impacting the asset's present value through discounted future cash flows at a higher rate. So, what is the capital asset pricing model? The capital asset pricing model is a way to figure out how much money you can make by investing in something and how risky that investment might be. It says that the amount of money you can expect to make from an investment depends on two things: the risk-free and return, which is like a guaranteed minimum amount of money you will get back no matter what, and the risk premium, which is extra money you might get if your investment does well. The risk premium part depends on something called beta, which measures how much an investment goes up or down compared to everything else. If an investment has a high beta, it means it's more likely to go on up or down quickly, so it's considered riskier than something with a low beta. Capital asset pricing model helps investors decide whether an investment is worth making based on expected return and level of risk. In terms of levered beta and unlevered beta, refer to two different ways of measuring the risk of companies' stock compared to the overall market. Levered beta takes into account both debt and equity as a company's capital structures, while unlevered beta only looks at equity. This is important because companies with more debt are generally considered riskier than those with less or no debt. Comparing a company risk as measured by its beta to the volatility of the overall market, we can get an idea of how much the company's stock price is likely to fluctuate in relation to changes in the broader economy. Unlevered beta can be especially useful when comparing companies with different capital structures since it focuses solely on equity risk and doesn't take into account differences in debt levels. The market risk premium is additional return that investors get when they hold a risky market portfolio instead of risk-free assets. This means that if you choose to invest in something that has more risk, you have the potential to earn more money than if you invested in something with less risk. However, it's important to note that higher returns usually come with a higher volatility or ups and downs in value over time. The idea behind this concept is that investors want to maximize the rate of return while maximizing the amount of fluctuation in their investments. Arbitrage pricing theory or EPT is an asset pricing model that predicts returns based on the relationship between expected return and microeconomic variables. It helps analyze portfolios for value investing by identifying potentially mispriced securities. The Gordon Growth Model, named after Myron Gordon, values a company's stock based on constant growth in payments to common equity shareholders. The model's key inputs are dividends per share, the growth rate in dividends per share, and the required rate of return. The dividend per share are the annual payments made on common equity shareholders, while the growth rate in dividends per share indicates the increase in dividends from year to year. The required rate of return is the minimum rate investors are willing to accept when purchasing a company's stock, and various models are used to estimate this rate.